Good day. Ira Epstein of Linn Associates with your financial market wrap-up for this Monday, 22nd of March, 2021, 6:35 p.m. Central Time. It is Fed Speak Week. What do I mean by that? A number of the Fed presidents are running around the country giving speeches. Fed Chair Powell has a date with ex-Fed Chair Yellen in front of Congress. So the Treasury Secretary and the head of the Fed are going to be there. I've already seen the outline of the speech that Mr. Powell is giving, and he is very, very focused on unemployment. You know, he's told us basically that they're going to anchor the front end of the curve yield. The back end can climb a bit. They're not there. He didn't say it should climb. He just said nothing about it, basically. And where's he focused? He wants people to get jobs. The Fed considers the unemployment rate, the official rate, way beyond what we get as this 6% number. They think it's closer to 9 or 10. And he's concerned about a certain group of wage earners, and that's what they're focusing on, and that's what he's going to talk about tomorrow. So the market likes that. It's not hearing rate hikes or breaks in any manner at all, and we'll look at what that does. Now, as you take a look at the S&P, the one thing that's consistent on the area chart of closes is you're staying over that 18-week average. As long as you do, the bias of the market longer term is to the upside. When we look at the S&P, you can argue that you had a vertical price rise from this break to this rally, and you've had a recent setback and no trend because of it. You've got a pattern of a higher high, a lower low. When you put on moving averages, the 18-day moving average, which I call the line in the sand, the market fell back to it, held it, which keeps the bias up. Anytime the market's over that number, I have bullish bias. Bearish bias when it's under. Because you don't have a trend, it's not giving me a bias to do anything in the market one way or the other. In terms of Bollinger Bands, frankly, you haven't been able to hit these Bollinger Bands since way back in January. So the Bollinger Band doesn't seem to be the number this market's hitting. It's probably a window envelope, if you know what those are. I show them in my morning subscriber video, which brings me to ask you, if you're watching this, hey, give us a subscribe on YouTube. It's for free. Then you'll know when these videos come out. And in addition, if you have questions or you have a like, I'd like to see that as well. I worked, by the way, all weekend and today recording videos for the enhanced Bollinger Band course. I might have 1 or 2 left. That's it. So it's this week. The release will be, they're going to start putting together everything as to where it resides on the website. It is a paid-for course. I've decided on the pricing and decided that all my paid subscribers, current paid subscribers, will get it with the cost that they're paying on an ongoing subscription for that. How do I mean by that? They're going to take that off the top price. That's your discount. So not only do you get the course, you're going to get a month free because I'm subtracting and you're still getting that. Does that make sense to you? So if you're paying $15 a month and the course were X, I'm taking $15 off the price of the course when you pay it. Other people were paying the full price. And that's how I'm going to keep going with my enhanced courses. It's a discount for the paid subscribers, not if you bought the course. That's a change in what I'm doing. As you take a look, higher high, lower low, still nothing there. Bollinger Bands above the market. Momentum, overbought. Watch. Here is Monday. Both numbers were not over 80, and they weren't over 80 the day before. So you're just overbought, drifting around between, let's call it this upper range here down to the 18-day average. And even if you soar it up, you're not going to have an uptrend. Why is that? Let me come back to that for you. Even if you went through this number, you'd have then a higher high but a lower low. So you can't get that stepping ladder. You can't get it in the NASDAQ. You have a pattern here of a higher high and a lower low. And instead of this market grabbing hold of the 18-day average, it's decided that the 100-day, who knows why, that's the important number. Did the market act well at the 18, offering some resistance? Well, you tell me. The market fell down, hit on Friday that 100-day average and came back, closed near the high of the day, literally within 40 points of the 18, Today you opened about steady, sliced through it. If you pull back, I wouldn't be surprised if it's got support there. Let's assume the market doesn't pull back and goes through this high. Big deal. You still have a lower low, higher high into the upper Bollinger Band of 13,392, and that is not an all-time high. In the Dow, this is the strength of the market. This is where the strongest looking chart is. You have the pattern of higher lows, higher highs with an embedded reading. So until the red line closes back under 80, I contend that on these breaks, the pros are buying the market, looking for it to go back to the Bollinger Band until it doesn't work. In the Russell 2000, you've got the lower highs, lower lows coming back to the 18-day average fighting. What do I call the 18-day average of closes? The line in the sand. And that's because that is the number that often a market decides where does it want to embark and do what. There's no pattern I see here that can instantly turn the market bullish, but any close back under now 2260 will enable the bears. They've already got momentum down. That would give them bias down, trend down for a pullback in that market. So that's how I'm viewing that one. In the VIX, you have an embedded reading, which means the market still looks lower. I will be surprised if the pros, if you ever do hit the lower Bollinger Band on the first challenge of it, I think they're going to write puts. If you go back in time and you see what they were doing last year, that was a very, very good strategy on the bottom. I don't recommend it on the top side because when you break out from these low levels, you can pop more than you think. But on the downside, it's been a very good pattern. Whether it'll stay that way, I cannot tell you. I am not predicting it will or won't. When you look at the 30-year bond, each time you hit that Bollinger Band, you're getting your bounces, as I'd think. But you lost the embedded reading. Now, did you lose it on Monday? You did. Did you lose it Friday? No. So the first day of loss was today, Monday. Now as you're reopening, you're not getting it back right away. That could easily say that this market wants to get back to the 18-day average to regroup itself. In the 10-year note, the market, did it embed? Well, let's take a look. We know it's not embedding tonight. It stayed embedded Monday because you had 3 days at least where the markets were underneath 20. Losing it tonight's the first warning signal that the market might be ready to rally back to the 18-day average, but it's too soon to tell. A 20.2 reading is what I call stochastic-itis. Means you're watching it at every little tick. Oh, it's 2070. Oh, it's down to 2020. Oh, it's back to 19. You don't want to do that. So at the end of the day, you take your look at the market. If you're in a short position right here, yeah, you might want to on breaks take advantage of that a little bit and don't be so much of a worrywart on it. You did hit your objective, so you're getting a bounce from it. In the dollar index, no trend. I know that everybody's going to say it's up. It's really not up that much. If you go back to January, where was this market? Fighting a battle at the 90 level for all purposes, okay? And now you're sitting here at a high of 92.18. So you've added, is that 2%? And you call that a big move? Okay, I don't. The market certainly is not giving the bears that thought it would be that way this year. They're coming, and there's reasons for it. No one thought that Europe would fall this far behind on their COVID vaccinations. They did, and that's hurting their economy. That was the bet. The bet was that emerging markets, including Europe, were going to do better than the U.S. because our rates were going to go up enough where we'd stall our economy. The problem in the equation came that they didn't get control of COVID. When they do, the bet is back on. Now you got to see when that bet comes on. That's my guess and my thinking on it. In the eurocurrency, the market has no trend pattern. You have a higher high, lower low. You've been staying under the 18-day average of closes really since back here, which was the beginning of the month, March. So now we're two-thirds, maybe a little more than that, and still not doing anything. Even if you got over 120.11. 120.11. It does nothing. A big rally, you still have a lower low, higher high. And nothing turns it bearish right here in terms of the swing line. I don't see anything to do with it. The British pound, What did I say? If you hit the lower Bollinger Band last week, if it hits it, look for support. Well, my gosh, look what that market did. It got to 138.22, went to the Bollinger Band and threw it by 2 ticks, and that's where you're at. So I'm not surprised with it. In a downtrend, you'd expect it. They're having big fights between the UK and the European Union about getting vaccines to them. And if you looked at the exports from the UK to the EU, they are down hard. Why? The EU's been making it difficult, and you didn't expect it was going to be easy, did you? If you look at tonight's break in this market, it's 537.30. This break was 534.75. So what you really have is a pattern of lower highs and higher lows, momentum turning down, and a battle at the 18-day average of closes. Nothing there. Brent, the differentials come in about 80 cents now, gone from just over the 360 level to the 289 level. You can see as the market has had a correction, we were talking about that last week, and the market had it. And again, this is tied to COVID. This is tied to that factor. There's other factors at work. You know, I'm still amazed that we're not getting more U.S. production out. Why do I say that? The word is that in the Permian Basin, it's $33 a barrel on average to get out of the ground your oil. Well, when we come to WTI on the futures, you're $61.28. So you got a $28 spread to get it out of the ground. Whatever the rest of your costs are, they are, but that's a heck of a lot to return. And I was on Bloomberg talking about this today. That gets rid of a lot of your debt. You're giving your investors back money, but at $61, that's a pretty sweet number, and the independents are probably having a field day with it. They don't have those other investors breathing down their back the way you do if you're more or less one of these public companies. But that type of oil stays there. Interesting. You're going to bring on production. Gasoline, you had this big break. Will you be able to get to the lower bands? You don't have to. You're pretty oversold. I have not forgot that we're in spring. And spring is not that it's eternal, but what spring is going to do is it's going to bring driving. And that driving is going to consume gasoline. That's going to consume oil. You get the pattern that's going to happen here. So I look at this as a break before another leg to the upside, basically. And natural gas, no, the market ran itself out of momentum. We talked about that too. Here you are, and this was on Friday, and if the market's going to lose that embedded reading, which it lost today, you want no further part of it. Let it do its thing. Probably coming back up here, regroup, and we probably saw the first wave of the downside. I'm not convinced there aren't other waves yet to come with it. So, I want to remind you, all the free offers we have, just go to our website, www.iraepstein.com. You'll see free offers, take advantage of them, and I'm Ira.